Well, fear in the markets today as investors and economists worry that Greece could be closer to defaulting on its debt. But it's not just Greece. There are also worries the ratings agencies may cut the ratings of French banks holding Greek bonds. So you can see the contagion there. And speaking of, analysts say they don't believe the U.S. can be insulated from this stress on European banks. Economists are already worried the U.S. is headed into recession and worry Europe could be the tipping point. But in a crazy world during these crazy times, President Obama took to the calm of the Rose Garden to try to sell his jobs bill.
You've got a world economy that is full of uncertainty right now. In Europe, in the Middle East, some events may be beyond our control. But this is something we can control.
Obama says the control that we have is whether or not lawmakers pass his jobs bill. But President Obama doesn't really have control to pass this measure with a divided Washington. So maybe that's why he felt he needed the extra support of an entourage this morning. He said they were teachers, cops, construction workers who could be helped by his bill. But just as he was making these public statements, trying to instill optimism, he kind of got a little bit, maybe not upstaged, but coming out at the same time, Bank of America released a statement saying it was laying off 30,000 employees to try to slash $5 billion a year to save that money. Now, this is just part of the ongoing saga with B of A that's included a $5 billion investment from Warren Buffett late last month, if you remember, to try to convince markets the bank isn't going bust. So what message are we really supposed to take away? What does all of this mean for Europe, for America, for average folks on both continents? Well, here to help us try and figure that out is Demetri Kofinas. He's an economics blogger, also an RT contributor. He's going to help us assess it. Thanks for being here. Thanks. So Greece runs out of money October 17th. Is it going to default?
If it doesn't have money October 17th, yeah, it will default. And technically, it's just a matter of how you define a default, because if most people think of default as a unilateral default on 100% of its debt, which is not necessary. They could default on 50%. They could do a haircut. But the markets pretty much expect a default of Greece, because if you look at 1 year Greek government debt, I believe it's now trading at over 100%. So that means if you invest in Greece now, supposedly you get double your money back plus the original investment. So
Demetri, level with me, because if the markets already think that Greece is in default, I mean, I saw Bloomberg says the chances are 98% in the next 5 years. That kind of supports what you're saying. Sitting here in the United States, sitting in this newsroom in Washington, what does that mean as an American and in America? Is this the tipping point that sets the country into recession?
I mean, there are a lot of economists like Nouriel Roubini who are now upping their. I mean, he originally thought we were going to be in a double dip, but more economists are saying that we are going to be, and Roubini thought it was going to be 2013. Now he's revising that estimate. He's moving it upwards. So the Greek default could precipitate a financial crisis, and because the system is so highly leveraged, any sort of crisis in the financial sector can affect the economy. So it could be the tipping point, but it seems pretty clear that we're heading in that direction anyway, and the U.S. may already be in a recession.
Which is something that people say. So then why all of this concern over Greece? It's a small economy. It's not one of the largest in Europe. Can you kind of explain why it's bigger than just Greece?
Well, I mean, not to draw a direct comparison between Greece and Lehman, but Lehman was not the entire economy. It was just one firm. And yet the collapse of Lehman Brothers sparked freeze in the credit markets. So the default of Greece could precipitate, theoretically, a panic in capital markets, because people would get worried about who's exposed. So there are French banks that are potentially on the hook with a lot of Greek debt. Now, who's exposed to those French banks? Then who's exposed to the banks that are exposed to French banks? So it could cause a psychological panic, which would cause investors and banks to go into the credit markets and demand more money, at the same time not be willing to lend money out, which is what we saw in 2008. That's the concern. And there's also a political concern, because if Greece were to default, it would really cause the unthinkable, because so far people have not been willing to discuss that. Only lately is it being talked about more and more, you know, what can we do? Because there is no real exit mechanism from the euro. If you're part of EMU, you're part of it supposedly for life, okay? And so we saw how chaotic it was when Argentina defaulted on its debt and exited the dollar peg. In the case of Greece, it's not even a peg. They've given up their currency. They're no longer just pegged after Maastricht. So it's a very dangerous and scary situation, and the Greek government's simply not prepared for it. And they've gotten used to, governments in Europe have gotten used to, especially countries like Greece and Portugal, for example, have gotten used to operating under this European patronage system where they don't have to make as many decisions as a sovereign country as they used to in the past, and they defer to Europe. And that's what you see in the case of Greece with a lot of those leaders.
If Greece defaults, is the euro done?
I don't think so necessarily. I mean, there are different ways that the European Central Bank and the EU could go about dealing with the default of Greece or an exit of Greece, Portugal, or some of the peripheral countries. They could break the euro into two different types of euro, a one-speed Europe and a two-speed Europe. But the fact that no one's willing to talk about that option openly and kind of admit that that's where we are with an unsustainable debt like Greece has, and now the fact that you have a country the size of Italy, which is no longer really able to access the markets the way that they're accessing the markets, but the ECB is in there buying Italian and Spanish debt. They've doubled the size of their purchases in sovereign debt in the last month alone. So the fact that you have these countries unable to issue debt paper on their own is frightening for the European Union and for the Eurozone.
And also for the United States, it sounds like. Now, one of the issues that you're touching upon is capital requirements, and that's something that's an unknown, that we still don't know about all of these banks in Europe or in the United States, what exactly is on their books. But it's kind of interesting because speaking of the Europe and American connection, the CEO of JP Morgan was saying something about European regulations and the impact on U.S. banks, and it had exactly to do with that, with capital requirements because of Basel. He said, I'm very close to thinking the United States shouldn't be in Basel anymore. I would not have agreed to rules that are blatantly anti-American. Our regulators should go there and say, if it's not in the interest of the United States, we're not doing it. Are these capital requirements as part of Basel anti-American?
Well, if anti-American is synonymous with anti-JP Morgan's profit margins, then yeah, it's anti-American. But that's all that Jamie Dimon is ultimately concerned about. And secondly, he's concerned about the financial system, which has grown in importance, and it's grown as a source of economic activity in the United States for the past 30 years. So he doesn't want capital requirements to be high, just like he came out before the audit of one of the major Irish banks when they were doing their auditing. I think it was back in March. And he said that he thinks that capital reserves, the reserve requirement should be somewhere around 7%. He doesn't want high reserve requirements because it puts a damper on what the bank can do as far as leveraging up. He prefers, and a lot of the banks prefer, an environment like they've had now, which is we can lever up as much as we want, doesn't matter, and if we lose, we just get bailed out. They have structurally adjusted their business model and their profit-making mechanism to this new environment, which has been perpetual bailouts that we've seen since 1980.
And it just goes to show that perhaps Dodd-Frank, which was supposed to end too big to fail, didn't, as many economists that I've spoken to have said. But doesn't Bank of America prove that these kind of requirements are necessary? We've seen Bank of America need $5 billion from Warren Buffett in order to calm markets. Now they just laid off 30,000 people to save $5 billion. Is this kind of the poster child for making the case for the kind of capital requirements in Basel?
Well, Bank of America is a disaster because they keep coming out and they keep saying that we're adequately capitalized, which is a story we hear all the time. You heard about Bear Stearns right until they got bought out for $2 a share. You heard it with Lehman Brothers up until the weekend that they had to file for bankruptcy. So it's a joke that they're coming out and saying this. No one can take it seriously. What you have to do is you have to look at what is Bank of America doing? As you said, they're laying off workers. Why are they laying off so many workers if they're adequately capitalized? Why are they getting money from Warren Buffett? Well, they say, we just want to prove to people that we don't need money. That's why we're asking for money. But people are scared, and they have a right to be scared because Bank of America bought up Countrywide, they bought up Merrill Lynch. Okay, so no one knows how exposed they really are. And in the case of a contracting U.S. economy that's already in the tank, if it were to contract more, if we were going to go back into a recession, well, all of a sudden, all these assets that banks have on their books that they're valuing at X, people are like, well, what is the real value of these assets? The same problem with Europe. You have underperforming or non-performing loans on bank books as assets that banks are holding and lending against, right? And the concern is what happens if these things aren't worth what we think they're being worth, and it could essentially blow up the system. So Bank of America is a prime example because of the fact that it's so heavily exposed to the mortgage market and because it had bought up Merrill Lynch. That's a big concern, but it's a concern for any bank progressively because all banks are exposed to other banks. And that's the contagion effect, and that's the fear.
And it's a fear that's going to continue. Would you say, though, that this Bank of America example and what's going on in Europe are proof that regulations have just not done anything?
Yeah, well, I mean, regulations, we've seen time and again, despite the fact that they've deregulated the banking system, right? But even the deregulations that they've done, banks have found ways to lever up. Despite those regulations. So we've been talking and hearing talk about regulating OTC derivatives, which are over-the-counter derivatives, right? The derivatives market. But that still hasn't really happened. And that's a perfect example of the need for regulation because you have all these banks making all these deals and no one, and that again creates the contagion risk because if you have all these side bets that could go haywire at any minute, it creates uncertainty, and that uncertainty then can freeze up credit markets. So it creates a state of dependency where the banking system constantly needs to be connected to the umbilical cord of the central banks, which is why need capital when you have credit, when you have infinite supplies of credit.
And so they're connected to the central banks, but yet average Americans, and I'm guessing average Greeks, dealing with their debt crisis, are cut off, and they end up losing in the end. We're going to have to leave it at that, but thank you so much for being here, Demetri Kofinas. That was economics blogger, also an RT contributor.